Welcome to Iraqi Dinar News, where you receive real and authentic updates about the Iraqi dinar. If you want to stay informed with moment-by-moment developments, make sure to subscribe to the channel and like the video. In today's update, we're going to take a closer and more grounded look at a question that continues to circulate widely among Iraqi dinar followers. If a revaluation, often referred to as an RV, were ever to occur, would it happen as a free-floating currency or within a controlled framework? This discussion is especially important because it touches on how Iraq's financial system is structured, how government budgeting works, and what realistic expectations should look like when analyzing currency movements. The claim presented suggests that Iraq cannot allow its currency to shift significantly or suddenly, particularly by large percentages, because the national budget is directly calculated based on the value of the currency. According to this view, any major fluctuation, such as a 20% change, would require a complete recalculation of the country's financial planning, which includes revenues, expenditures, and deficit projections. Therefore, the argument concludes that the Iraqi dinar must remain within a very narrow and controlled range, rather than being allowed to float freely in global markets. To properly analyze this, we need to break it down into key components: how exchange rate regimes work, how Iraq structures its budget, and what a realistic path for currency reform might look like in both the short and long term. First, let's talk about exchange rate systems. Broadly speaking, currencies operate under either a fixed exchange rate, a managed float, or a free float. A free-floating currency is determined entirely by market forces, supply and demand in global foreign exchange markets. Examples of this include major currencies like the US dollar, euro, and Japanese yen. These currencies can fluctuate daily, sometimes significantly, based on economic data, geopolitical events, and investor sentiment. On the other hand, a fixed or pegged exchange rate is controlled by a country's central bank, often tied to another major currency, typically the US dollar. Iraq currently operates under a managed exchange rate system, where the Central Bank of Iraq plays a significant role in maintaining stability. This system is designed to reduce volatility and maintain confidence, particularly in an economy that is still developing and heavily dependent on oil revenues. Now, here's where the budget connection becomes critical. Iraq's national budget is largely built on oil exports, which are priced in US dollars. However, once those revenues enter the domestic economy, they are converted into Iraqi dinars to fund government spending. This includes salaries, infrastructure projects, public services, and subsidies. Because of this, the exchange rate between the dinar and the dollar becomes a foundational assumption in the entire budgeting process. If the value of the dinar were to change significantly, whether appreciating or depreciating, it would directly affect how much local currency the government has available to spend. For example, if the dinar were to strengthen dramatically, the government would receive fewer dinars for each dollar of oil revenue. This could create budget shortfalls unless adjustments are made. Conversely, if the dinar weakens, the government would receive more dinars per dollar, which might temporarily ease fiscal pressures, but could increase inflation and reduce purchasing power for citizens. This is why the claim about a narrow window has some economic logic behind it. Large sudden changes in exchange rates can create instability, not just in government finances, but across the entire economy. Businesses, investors, and consumers all rely on predictable currency values to make decisions. A sharp and unexpected shift could disrupt trade, increase uncertainty, and potentially trigger capital flight. However, it's also important to clarify what this does and does not mean. The idea that Iraq cannot change its currency value at all is not entirely accurate. Countries do adjust their exchange rates over time, but these adjustments are typically gradual, carefully managed, and supported by broader economic reforms. In Iraq's case, any meaningful change in the value of the dinar would likely be part of a long-term strategy, involving monetary policy, fiscal discipline, banking sector reforms, and increased economic diversification. Now, let's address the specific concept of a float. A full free float, where the Iraqi dinar is left entirely to market forces, would require a highly developed financial system, strong institutional credibility, deep foreign exchange reserves, and a diversified economy. While Iraq has made progress in some areas, it still faces structural challenges, including reliance on oil revenues, political complexities, and the need for continued financial sector development. Because of these factors, it is more realistic to expect that Iraq would maintain a managed system, rather than moving directly to a free float. This could involve gradual adjustments to the exchange rate band, increased flexibility over time, and continued intervention by the central bank to prevent excessive volatility. In the short term, this means that any significant or sudden revaluation event is unlikely to occur in the way it is sometimes described in speculative discussions. Instead, changes, if they happen, are more likely to be incremental and tied to measurable economic improvements. These could include higher foreign reserves, stronger non-oil revenue streams, improved banking transparency, and greater integration into global financial systems. From a long-term perspective, Iraq's goal would likely be to strengthen the credibility of its currency and create a stable environment that attracts investment. This involves not just exchange rate policy, but also broader economic reforms. A stable and predictable currency can support trade, reduce inflation risks, and build confidence among both domestic and international stakeholders. For Iraqi dinar followers, the key takeaway is the importance of understanding the difference between speculation and economic reality. Currency values are influenced by complex factors, including fiscal policy, monetary policy, global market conditions, and internal economic performance. Simplified narratives that suggest sudden and dramatic changes without corresponding economic fundamentals should be approached with caution. It's also worth noting that central banks, including the Central Bank of Iraq, prioritize stability above all else. Their mandate typically includes controlling inflation, maintaining financial stability, and supporting sustainable economic growth. Any decision regarding the exchange rate would be made with these objectives in mind, rather than aiming for rapid or extreme shifts. Another important aspect to consider is the role of international institutions. Organizations such as the International Monetary Fund often work closely with countries like Iraq to provide guidance on monetary and fiscal policy. These partnerships generally emphasize gradual reform, transparency, and risk management. Sudden, large-scale currency adjustments would not align with these principles and could undermine progress. As we analyze this discussion further, it becomes clear that the idea of a tightly controlled exchange rate is not just a limitation, but also a deliberate policy choice. By maintaining a narrow range, Iraq can reduce uncertainty, stabilize prices, and create a more predictable economic environment. This is particularly important in a country that is still rebuilding and working to strengthen its institutions. At the same time, maintaining a fixed or tightly managed exchange rate requires strong foreign currency reserves. The central bank must be able to intervene in the market to defend the currency when needed. Iraq's oil revenues play a crucial role in this, providing the dollars necessary to support the dinar. However, this also highlights the importance of diversification, as reliance on a single revenue source can create vulnerabilities. Looking ahead, any evolution in Iraq's exchange rate policy will likely be gradual and closely linked to broader economic progress. This could include steps toward greater flexibility, but always within a controlled framework. The transition from a managed system to a more flexible one, if it occurs, would take years rather than happening overnight. In conclusion, the claim that Iraq cannot allow its currency to fluctuate significantly due to budget constraints is grounded in real economic considerations. The structure of the national budget, the reliance on oil revenues, and the need for stability all support the idea of maintaining a controlled exchange rate. However, this does not mean that change is impossible. It simply means that any change must be carefully managed, gradual, and supported by strong economic fundamentals. For viewers and followers of Iraqi dinar developments, The most responsible approach is to focus on verified information, understand the underlying economics, and avoid expectations of sudden or guaranteed outcomes. Currency movements are complex and often slow-moving, reflecting deeper structural changes rather than isolated events. As always, staying informed through credible sources and maintaining a balanced perspective is key. If you found this analysis helpful, make sure to subscribe to the channel for more responsible and factual Iraqi dinar updates. And remember, this content is for informational purposes only and should not be considered financial advice.